So now that we've completed all of our lower level budgets, the sales budget, the production budget, the direct materials budget, the direct labor budget, the manufacturing overhead budget, the cost of goods sold budget, and the SG&A budget, we can move on to our cash budget. This is going to estimate the company's cash inflows and outflows over this period of time. Essentially, when are we going to receive money and when do we have to pay out cash to the people that we owe money to? In order to prepare a cash budget, we are going to have to make two documents beforehand. The first being the schedule of cash receipts, which records the collections of cash that we're going to have during the period, and the second being the schedule of cash payments. Let's start with the schedule of cash receipts. This is going to be Saratoga Chips' schedule of cash receipts. For the first line, total net sales, what we're going to need our sales budget. Our sales budget already has the information for total net sales. We're simply going to copy the numbers from the bottom row on our sales budget up until the total net sales row on our schedule of cash receipts. So we had $245,000 worth of total net sales during the first quarter. We had $296,450 in total net sales during the second quarter. We had $323,400 in total net sales during the third quarter, and we had $245,000 in total net sales during the fourth quarter, for a total of $1,109,850 in sales. Moving on to the section below, the cash receipts from customers section, we're going to start with our AR balance at the end of the prior year. If it is the accounts receivable balance at the end of the prior year, it needs to be our accounts receivable balance at the beginning of this current year. And from our information on the left-hand side, we see that Saratoga Chips had $50,000 in accounts receivable at the beginning of the year. We simply fill in that number. The next row down is our first quarter cash sales, and in the information on the left section, it says that Saratoga Chips predicts that 10% of all sales will be in cash. So how do we know what number to fill in? We take our total net sales for the period and we multiply it by that 10%. If the company is going to have $245,000 in total net sales during the first quarter and 10% of those are going to be in cash, that means $24,500 worth of cash will be collected from cash sales alone. The remainder of these sales that aren't cash are going to be credit sales, and we know from our information that Saratoga Chips expects to collect 75% of all credit sales during the quarter of sale. So for the credit sales that we have during the first quarter, Saratoga Chips expects to collect 75% of those. To figure this out, we take the total amount of net sales that we had during the period and subtract out the cash sales that we had. We had $245,000 in total net sales. We had $24,500 in cash sales. The remainder of that is our credit sales, and we know that we're going to collect 75% of them during this period, so we multiply that difference by 75%. Next up, we have our Q1 credit sales collected in quarter 2. We're not collecting the entire 100% of our credit sales during the quarter of sale. The last 25%, according to our information, will be collected during the following quarter. So to figure out our quarter 1 credit sales collected in our second quarter, we take the same formula that we had, $245,000 in total net sales from the first quarter, minus our cash sales from the first quarter of $24,500, and we multiply that this time by 0.25, the 25% remaining that we have to collect. And that's going to come out to be $55,125. It goes into the second quarter column because we are actually collecting this cash during the second quarter. For the second quarter cash sales, we take the total net sales for the second quarter and we multiply it by that 10% that we expect to collect in cash. $296,450 times 0.10 means that we're going to collect $29,645 in cash from our cash sales alone. For our credit sales, we need to figure out what the 75% of credit sales for the period is that we're going to collect during the quarter. And to do so, we take the total net sales, $296,450. We subtract out the portion that we already collected in cash, which is $29,645, and we multiply that difference by that 75%. This comes up to a total of $200,104. The row below, we have our second quarter credit sales, which we're going to collect during the following quarter, quarter 3. We're going to use the same formula that we did before. We're going to take the second quarter's net sales, subtract out the amount of cash sales we expect to collect during the second quarter, and multiply that by the 25%. We're going to collect 25% of our credit sales in the second quarter during the third quarter, and that number comes out to be $66,701. Next, we have our third quarter cash sales, which again is going to be 10% of all net sales during the period. Our net sales were $323,400. If we multiply that by 10%, we determined that Saratoga Chips is going to collect $32,340 worth of cash sales during the third quarter. To figure out their credit sales collected during the third quarter, we take the total net sales, subtract out our cash sales, and multiply that by 0.75, our estimated rate of collection during the quarter of sale. This tells us that the company is going to collect $218,295 in cash from credit sales in the third quarter. The remaining portion of those third quarter credit sales are going to be collected in the fourth quarter. So to figure that out, we take our third quarter's total net sales, $323,400, subtract out our third quarter's cash sales of $32,340, and multiply that by 25%, and we come up with the third quarter credit sales collected in the fourth quarter as $72,765. Next, we have our fourth quarter cash sales. We had $245,000 in total net sales during the quarter. If we multiply that by the 10% that we predict we're going to collect in cash, that means we are going to collect cash equal to $24,500. For our fourth quarter credit sales collected in the fourth quarter, we are going to take the amount of total net sales we had during the fourth quarter, $245,000, subtract out the amount of cash sales that we had, $24,500, and multiply that by our 75% estimated rate of collection. That's going to tell us that Saratoga Chips is going to collect $165,375 on their third quarter or fourth quarter credit sales during the fourth quarter. Which leads us to our total cash receipts from customers column. To figure this out, all we do is we take all of the respective balances within that quarter's column and we add them together. So in the first quarter, Saratoga Chips is going to collect the $50,000 that they had in beginning receivables, plus the $24,500 that they had in cash sales, plus the $165,375 of credit sales that they collected within that quarter. It's going to give them a total cash receipts from customers during this quarter of $239,875. We're going to repeat this process for the second quarter, adding the total of our quarter one credit sales collected in the second quarter, our second quarter cash sales, and our second quarter credit sales collected in the second quarter to come up with $284,874. That is the amount of cash that Saratoga Chips expects to collect during the second quarter. In the third quarter, they're going to collect $317,336 in cash, and in the fourth quarter, we add those three numbers together and determine they're going to collect $262,640 in cash, meaning that for the year, Saratoga Chips is going to collect $1,104,725 in cash from their customers. And that is the conclusion of the schedule of cash receipts. At the end of preparing the schedule, we can also determine what the ending value of our accounts receivable is, much in the way that we were determining what the portion of a quarter's credit sales that we collected in the following quarter was going to be. Let's go back to our schedule of cash receipts from customers. I have all of our information right here to determine the ending value of AR for the company. What we're going to do is we are going to take the amount of sales that they had in the fourth quarter, which was $245,000. We are going to subtract from that the amount of cash sales that they had during the quarter, which was $24,500 in the fourth quarter, giving us fourth quarter credit sales of $220,500. We already know that Saratoga Chips expects to collect 25% of all credit sales in the quarter after they made the sale. So if it's the fourth quarter of 2019 and they're making these credit sales, they would collect in the first quarter of 2020. And 25% of their fourth quarter credit sales would equal $55,125. That is their ending accounts receivable balance at 2019's year end. We can use our schedule of cash receipts to check our work. What we're going to do is we're going to start with our total net sales, which for the year was $1,109,850. We are going to add to that our beginning accounts receivable, which you can find as the first number under the first quarter column, which was $50,000. And we'll subtract from that the ending accounts receivable that we had, which we just determined was $55,125. When we perform those calculations, we come up with total cash receipts from customers for the year of $1,104,725, which if you look in the bottom right hand corner of our schedule of cash receipts, you can see was their total cash receipts from customers. So our numbers check out. Now that we're done with our schedule of cash receipts, we can move on to our schedule of cash payments. Schedule of cash payments is rather large, so we're going to split it into two different sections. The first section being for the payments for direct materials. On the first row, our total direct materials purchases, we can simply go to our direct materials budget. The bottom row of our direct materials budget, we have our budgeted cost of direct material purchases. All we're going to do is copy those numbers from our direct materials budget over to our schedule of cash payments. So we expect to have total direct materials purchases of $30,795 during the first quarter, $33,615 during the second quarter, $34,590 during the third quarter, and $30,000 during the fourth quarter. And our total is going to be $129,000, just like it was on our direct materials budget. In the cash payments for direct materials section, we're going to start with our accounts payable balance at the end of the prior year, which again will be our beginning balance for this year. In our information given on the left hand side, we've seen that Saratoga Chips will have a $19,000 balance to accounts payable at the end of the year. So we're going to start with $19,000. We're going to add to that our Q1 purchases, which were paid in quarter one, the amount of the direct material purchases that we have that we are going to pay for during the period. So what we do now is we figure out what our rate of collection is. Well, in the second section of our info, it says that Saratoga Chips expects to pay for 80% of direct materials during the quarter of purchase. That means that we are going to pay for 80% of the $30,795 worth of direct materials that we're buying in the first quarter within the first quarter. And when we multiply 30,795 times 0.80, we come up with 24,636. The remaining balance of first quarter direct material purchases is going to be paid during the second quarter. And according to our information, Saratoga Chips will pay off the remaining 20% of their direct material purchase balance during the following quarter that they made the purchase. So we take that $30,795 and we multiply it this time by 0.20, the remaining 20% that we owe for these direct materials, which is going to be $6,159. Next, we need to figure out the portion of our second quarter direct material purchases which we are actually paying for in the second quarter. And we know that we pay for 80% of all purchases in the quarter that we made that purchase. So the $33,615 in total direct materials that we purchased, we're going to pay for 80% of that. We're going to figure it out by taking $33,615, multiplying it by 0.80, and determining that Saratoga Chips is going to spend $26,892 on direct material purchases in the second quarter. The remaining balance of the second quarter's purchases are going to be paid for in the third quarter. That's the last 20%. So we multiply 33,615 times 0.20 and we come up with $6,723. For the third quarter, we're going to pay for 80% of the $34,590 in direct material purchases we made during the third quarter, actually within the third quarter, and 80% of that is $27,672. The remaining 20% of the third quarter's purchases will be paid for during the fourth quarter, so we take $34,590 and we multiply it by 0.20, and we come up with $6,918 in cash that we are going to pay for our third quarter direct material purchases during the fourth quarter. And then lastly, in the fourth quarter, we are going to pay for 80% of the fourth quarter's direct material purchases of $30,000. So we take $30,000, multiply by 0.80, and we come up with $24,000. In total, we need to figure out what our total payments for direct materials were during each quarter. So for the first quarter, it is paying off the beginning accounts payable balance that we had, plus the amount of our first quarter purchases that we actually paid for in Q1. $19,000 plus $24,636 equals $43,636. In the second quarter, we paid for the remaining $6,159 that we owed on direct materials from the first quarter, plus the $26,892 that we're paying towards second quarter's purchases, comes out to a total of $33,051. We just continue to add the two numbers in each column together to determine the total payments for direct materials. It'll be $34,395 for the third quarter and $30,918 for the fourth quarter, giving us total payments for direct materials during the 2019 year of $142,000. Now that we've completed the top half of our schedule of cash payments, the direct materials portion, we can move on to the other expenses that we had. We're going to start with direct labor. To figure out our total payments for direct labor during the period, we go to our direct labor budget, and we see, according to our direct labor budget, that we had $51,000 worth of budgeted direct labor costs during the first quarter, $55,500 during the second quarter, $59,000 during the third quarter, and $50,000 during the fourth quarter, for a total of $215,500. For the manufacturing overhead section, we need to go to our manufacturing overhead budget. As you'll see on here, we had variable manufacturing overhead, our budgeted VOH, the third row down on our manufacturing overhead budget, of $10,200 during the first quarter, $11,100 during the second quarter, $11,800 during the third quarter, and $10,000 during the fourth quarter, meaning we had total variable overhead expenditures during the year of $43,100. Next section that we have is our utilities, insurance, and property taxes. For the first quarter, second quarter, third quarter, and fourth quarter, it was $9,000 each quarter, which means that Saratoga Chips is going to pay $36,000 in expenses for utilities, insurance, and property tax during the year. What we didn't include here was the depreciation section under fixed overhead. Why? Because fixed overhead, or depreciation by its nature, is a non-cash expense. When your computer loses value, when your car loses value, you don't have to hand over cash to someone to, pay for that lost value on your car. So depreciation has no place in a schedule of cash payments. We're simply going to admit it. And our total cash payments for manufacturing overhead is simply the sum of our variable manufacturing overhead plus our costs of utilities, insurance, and property taxes, which was $10,200 plus $9,000 for the first quarter, giving us total payments for manufacturing overhead of $19,200. We're going to add these two numbers together to determine that we had $20,100 in payments for manufacturing overhead during the second quarter, $20,800 payments for manufacturing overhead during the third quarter, and $19,000 in payments for manufacturing overhead during the fourth quarter, meaning that our total manufacturing overhead payments were $79,100. For our SG&A section, we're going to need to go to our selling and administrative expense budget. According to our expense budget, we're going to pay $24,000 in cash for salaries expense each and every quarter, for a total of $96,000 during the year. For rent expense, we pay $6,000 each quarter, for a total of $24,000 during the year. For insurance expense, we're going to pay $900 each quarter. That's going to give us a total of $3,600 in cash payments that we have to make during the year for our insurance expense. And supplies expense, we calculated on our selling and administrative expense budget, and it was $4,900 in payments during the first quarter, $5,929 during the second quarter, $6,468 during the third quarter, $4,900 during the fourth quarter, giving us a total amount of supplies expense payments of $22,197. We did not include our depreciation expense, again because it's a non-cash expense. To figure out our total payments for SG&A expenses, we're just going to add together the amount that we paid for salaries, rent, insurance, and supplies within that quarter. We had payments of $35,800 in total during the first quarter, $36,829 during the second quarter, $37,368 during the third quarter, and $35,800 during the fourth quarter. And you may notice these don't match the total budgeted S&A expense. Why? They're all $800 less because we did not include depreciation, meaning that our total payments are going to be $145,797. Next up, we have our income taxes, which, given in the information on the left-hand side, it says that Saratoga Chips is going to pay $28,000 every quarter to the IRS to pay for these taxes. So $28,000 every quarter gives us a total of $112,000 in cash payments that we have to make to the IRS. And lastly, we have our total payments for capital expenditures, and these would typically be recorded on the capital expenditure budget. But for the sake of space and time, we're just going to go straight to our cash budget. We have one capital expenditure. It is buying a $140,000 piece of equipment. We're going to spread the cost of that $140,000 by making equal installment cash payments every quarter over all 4 quarters. So to figure out how much we have to pay each period, we take that $140,000 and we divide it by 4. It means we're going to pay $35,000 towards this equipment in the first quarter, $35,000 in the second quarter, $35,000 again in the third quarter, and $35,000 again in the fourth quarter, which will be our total $140,000 payment that we have to make. To figure out your total cash payment before interest, what you need to do is sum up every row that starts with the word total. So we're going to take our total payments for direct materials. We're going to add to that our total payments for direct labor, our total payments for manufacturing overhead, our total payments for SG&A expenses, our total payments for income taxes, and our total payments for capital expenditures. And in total, in the first quarter, when we take our $43,636 for direct materials, our $51,000 for direct labor, our $19,200 for manufacturing overhead, our $35,800 for SG&A expenses, our $28,000 for total payments for income taxes, and our $35,000 in cash that we're paying towards our capital expenditure, our purchase of equipment, we come up with total cash payments before interest of $212,636. We're going to continue to add the numbers from those 6 respective rows for each quarter. In the second quarter, we're going to have total cash payments before interest of $208,480. In the third quarter, it's going to be $214,563. In the fourth quarter, it's going to be $198,718, giving us total cash payments before interest of $834,397 for the year, the sum of the 4 numbers listed in the total cash payments before interest column. Now that we have all the information from those 2 budgets, we can actually prepare our cash budget. We start with this following info: that Saratoga Chips is going to have $20,000 in cash at the beginning of the year. The Saratoga Chips is instituting a policy where we must have a minimum cash balance of $60,000 at the end of the quarter. If we do not, we're going to have to take out a loan. And if we do have to take out a loan, we can borrow in increments of $1,000 at 4% annual percentage rate. We have to pay off the loan in full as soon as we have sufficient cash access to do so. And we'll show you how that works in a minute. But let's first start with our beginning cash balance in the first quarter, which according to our information was that $20,000. We're next going to add to that the amount of cash we had in cash receipts, which we can go to our schedule of cash receipts for customers and figure out what our total cash receipts were during the first quarter, and they were $239,875. When we add those 2 numbers together, that's going to give us our cash available. We have $259,875 in total cash available during the period, but now we need to figure out what we spent cash on. So for capital expenditures, we're going to go to our schedule of cash payments budget, and we're going to find out that during the first quarter we had cash payments for capital expenditures of $35,000. Next, we have to figure out what we paid in cash for the purchase of direct materials, which you'll find on the very top row of the schedule of cash payments on your left-hand side, which was $43,636. For direct labor, next row down, we paid $51,000. For manufacturing overhead, our total payments for manufacturing overhead were $19,200. Our total selling and administrative expenses were $35,800, and our total payments for income tax was $28,000. And nowhere in the information does it say we have any outstanding loans at this point, so we're going to assume that our interest expense is 0. When we add up those 7 numbers in the cash payment section, we find out that our total cash payments during the first quarter were $212,636. So now we need to figure out what our ending cash was before financing. And to do so, we take our cash available, which was $259,875, and we subtract out the $212,636 worth of cash payments that we made. If we had $259,875, but we spent $212,636 of it, it means that our remaining cash can only be $47,239. And this is going to provide a problem because we have a policy that we have to have a minimum cash balance of $60,000 at the end of every period, which means that we have a cash deficiency of the difference between the amount of cash we have and the amount of cash that we require, our $47,239 and the $60,000 balance we have to have, which means we are short $12,761 in cash. We are going to have to borrow money. We have a cash deficiency below our minimum cash balance. How much money are we going to have to borrow? Well, we can only borrow in increments of $1,000. So the next multiple of 1,000 that's going to give us enough cash to cover our cash deficiency is $13,000. We don't have any principal repayments right now, which means that our total effects of financing is we're going to borrow that $13,000. Well, we add that $13,000 that we borrowed to the $47,239 that we had in cash, we come up with an ending cash balance of $60,239, which is more than our $60,000 requirement. So for right now, we have enough cash to meet our minimum. For the second quarter, our beginning cash balance is going to be equal to our ending cash balance at the end of the prior quarter. If we ended the first quarter with $60,239 in cash, that means we're going to begin the second quarter with that same $60,239 in cash. Our cash receipts during the second quarter, again from our schedule of cash receipts from customers, were $284,874. We're going to take that number, we're going to add it to our beginning cash balance, and it's going to give us cash available of $345,113. Again, we need to go to our schedule of cash payments to figure out how much we spent on these various activities during the period. Our capital expenditures in the second quarter was once again $35,000. Our purchase of direct materials during the second quarter was $33,051. Our payments for direct labor during the second quarter were $55,500. Our manufacturing overhead payments were $20,100. Our selling and administrative expenses were $36,829. And our payments towards income tax were $28,000. For interest expense, we do have a loan now. We borrowed $13,000 at the end of the previous period. So to figure out how much money that we owe on this loan, we're going to have to take the amount that we borrowed and multiply it by our annual percentage rate. We have a 4% loan. So if we take $13,000 and multiply it by 0.04, we get the amount of interest that would be accrued on that loan. However, the A in APR stands for annual. It means we have to pay 4% per year. Well, this isn't for a whole year. It's only for a quarter. And since there's 4 quarters in a year, we need to divide the product of 13,000 and 0.04 by that 4, the number of quarters in the year. That's going to come out to be $130. This is the amount of interest that we have to pay for on our loan. So now to figure out our total cash payments, we add up those 7 numbers in the cash payment section under the second quarter, and we come up with $208,610. We determine our ending cash balance before financing by taking our cash available of $345,113 and subtracting out our total cash payments of $208,610, and we come up with $136,503. We have $136,503 in ending cash before we have any effects from financing, which is well above our minimum cash balance of $60,000. In fact, it is $76,503 greater than the minimum amount we want to have. This is our cash excess. And according to the information in the loan section, as soon as we have sufficient cash access to pay off the balance of our loan in full, we will do so. Well, we have more than $13,000 in cash access. So since we have enough cash, we are going to pay off our loan right now. Our principal repayment is going to be to pay off that $13,000 we owe on the loan. So what we do is we subtract that from the amount of ending cash we had before financing, our $136,503. Take out the $13,000 that we're going to use to pay off the loan. And we're going to come up with an ending cash balance of $123,503. The ending cash balance we have $123,503 at the end of the second quarter becomes our beginning cash balance at the beginning of the third quarter. So we carry that $123,503 over to the beginning of the third quarter. To figure out our amount of cash receipts during the third quarter, we once again go to our schedule of cash receipts from customers, and we see that we are going to collect $317,336 from our customers during the third quarter. To determine our cash available, we add together our beginning cash balance of $123,503 to our cash receipts of $317,336, and we come up with cash available of $440,839. To record our cash payments, we go back to our schedule of cash payments. In the third quarter, we are going to pay $35,000 in total payments for capital expenditures. Our purchase of direct materials is going to cost us $34,395. Our total payments for direct labor are $59,000. Our total payments for manufacturing overhead will be $20,800. We're going to have total payments for SG&A expenses of $37,368. And our income tax payments are going to be $28,000. our loan is completely paid off at this time, so we're not going to have to accrue any interest that we owe. We don't have to pay off any interest expenses, so we have an interest expense of 0, meaning that our total cash payments are the sum of the 7 numbers in the cash payment section for the third quarter, and that's going to be $214,563. To figure out our ending cash balance before financing, we take the total cash available in the third quarter of $440,839, and we subtract from it the amount of cash payments we made, which was $214,563. We come up with $226,276 in ending cash before financing. If we subtract from that our minimum cash balance of $60,000, we figure out that we have a projected cash excess at the end of the third quarter of $166,276. We have no outstanding loans, so we can skip the financing section entirely and just bring down our ending cash balance, which is $226,276. That number that we had at the end of the third quarter is going to become our number at the beginning of the fourth quarter. So we bring over our $226,276. We add to that our cash receipts from the fourth quarter of $262,640, and that becomes a total amount of cash available equal to the sum of those two numbers, or $488,916. For our cash payments, we one more time go to our schedule of cash payments. We're going to pay $35,000 for capital expenditures in the fourth quarter. We're going to pay $30,918 for total direct payments. Saratoga is going to pay $50,000 for direct labor. They're going to pay $19,000 for manufacturing overhead, and they are going to pay $35,800 for selling and administrative expenses. Income taxes are still $28,000, and since we don't have any loans, our interest expense is going to be 0, meaning that our total cash payments for the period is going to be $198,718. To determine our ending cash balance before financing, we take our $488,916 and we subtract from it the amount of cash payments that we're going to make of $198,718. We come up with an ending cash balance of $290,198. Our minimum cash desired is $60,000. We are well above that. In fact, we have a $230,198 cash excess. We have no financing information. We have no outstanding loans. So our ending cash balance is going to be equal to our ending cash balance before financing, or $290,198. For the year, we can figure out our total column. At the beginning of the year, we had $20,000 in cash balance. Our total cash receipts for the year is the sum of the cash receipts row, which was $1,104,725. Our cash available, we don't need to worry about. Our cash payments, we paid $140,000 for capital expenditures. We paid $142,000 for direct materials. We paid $215,500 for direct labor. We paid $79,100 for manufacturing overhead. We paid $145,797 for selling and administrative expenses. Our total income tax payments were $112,000, and we had interest expense of $130 during the year. All I'm doing is summing up the rows for each respective expenditure, meaning that our total cash payments during the year were $834,573. Our ending cash balance before financing at the end of the year was $290,198. We still have a desired minimum of $60,000, meaning that our projected cash excess is $230,198. For the financing section, we borrowed $13,000, but we repaid that $13,000, which means that we don't have any total effects of financing. Our ending cash balance is therefore equal to our ending cash balance before financing, which was $290,198. This is the end of our cash budget.